the question they ask is, where is inflation persistence coming from?
Where is it?
Well, I was thinking, used cars, maybe, semiconductors, eggs. You've heard it. Who can forget those fraught eggless weeks of February 2023?
You have to remind us of the dark days.
Is that the answer? Is eggs inflation? No, it's not those. It's rents. Oh, I'm sorry
It's our fault. It's our fault.
for burying the lead a little bit, but it is rents. Viewers and listeners of the Great Report all know full well that, and we've just said it, rent of primary residence is the most out of whack metric in the consumer price index. The Fed knows it, and it shows it. You can see separated into different colors, different factors that are contributing either in the positive or the negative to the run-up in inflation and the moderation of inflation. Right now, we have housing. They lump housing together, but for all intents and purposes, this is rent. Rent is the one that's driving these housing prices right now. They have made another metric called the Multivariate Core Trend that kind of corrects for these housing delays. Basically, it means that housing flips from contributing like positive 0.65 to negative 0.1. So if we are really accurately calculating rent at this point and figuring it into our calculation of core CPI, then it would be negative 0.1. It would be much lower. A full swing of 0.65%. That's huge in the context of the entire inflation for just such a tiny chunk.
So that's what it would be if we were looking at CPI more in real time, or rent, rent growth relative to CPI.
And the real upshot to all this is that I think they have their multivariate core index has inflation in the negative. I'll have to look at the line graph, but basically it's not fully in the negative, but it is definitely trending negative. Now, I think that was what that bar graph was saying. It's like, how much is each of these factors contributing to the trend?
Yeah.
But clearly falling off maybe more powerfully than the kind of top line numbers. So
we're saying it's rents.
Yeah.
Now, but coming back, what about the more than a year or so? I mean, we know if rents are going to go down, so we know that like in a couple months, within a year, it should drop down.
Yeah.
When we talked about, wages, we talked about some of these contracts. What else? Because, it's interesting, you hear there's a lot of different opinions if it's going to be higher for longer, or we're going back to 2019. I think it's, probably somewhere in the middle, moderately higher, but I see the argument for like, it's not going to be down to very low rates, like very soon without a major downturn and recession, which I think is going to have to be caused by some black swan that we're not aware of right now. And if not, we're going to see a moderate inflation, but I don't see it. I mean, we're down to 3%.
Yeah.
So like, that's not, there was discussions of where like 3% should be the inflation target.
Yeah. Well,
remember that debate?
Well, yeah. And I remember,
what's wrong with 3%?
It's still part of the discussion. It's higher for longer. Get used to it, kind of.
But it is higher 3%. And if what's the base? What's the model? What are the inputs to get us now back to 5%? Because that's going to mean we're going to have a lot more inflationary pressures. What's that going to come from? We're not seeing the rent growth anymore.
Really good point. Because short of, if we're talking core, that takes out gas and food, it's hard to see. There's always things, that swing.
Onshoring is big.
Yeah.
That is going to be inflationary, but that's going to be a low burn, over time, and probably going to be, good for, the economy, and it's going to be more isolated in different markets. It's going to be inflationary for like in markets like the Midwest, because it's going to be a lot more jobs coming in, a lot more economic activity, which is kind of fine. The Midwest is usually like a little bit below growth, so
Well, and we were just talking about this before, as is the global factors. If China is massively stimulating, if there's still inflation in Europe, there's still a lot of time.
Well, that's the thing. The trend sort of, if you look at China, whatever indicator that could be, but they're on the brink of deflation right now.
Oh, okay.
China, they're deflating. They're
really trying that hard.
China's stimulating. They're printing money because there's so much deflation in their economy. And so on one hand, it's like there's enough global deflationary pressures, and China is again, it's not the United States, but it's one of the world's largest, second, first, economic powerhouse.
Yeah.
They have if there's deflationary forces coming from that large part of the global economy, what does that tell you about the trend? And then when they're stimulating, again, one of the world's largest economic powers, if they're pumping stimulus into the economy, which is inflationary.
Good for us.
Yeah, so it's exactly. It means that can we really have a big crash and demand drop off so much when there's still so much stimulus going on?
Can you bring back that bar graph? Because it may help figure out what are these big factors. So if you look at it, the biggest factor that you can see on the side of the moderation is shelter in the core inflation, bringing inflation up. On the run up, the biggest factor for core inflation was the motor vehicles and parts. I don't know that much about motor vehicles. I knew that the computer chips were making cars harder to build. So that was, and I think also people realized during the pandemic, like, oh, cars are worth a lot. I do need that.
Well, but then the amount of debt that consumers have on vehicles right now, and vehicles right now are like more unaffordable than it's like the single family home. The monthly payments for a car right now, if you get a new car, are crazy.
I keep putting off getting a new car. My car, as it shifts into second gear, maybe it's third, but I pat myself on the back every day I drive it. I'm making money.
It's like ching. Yeah, seriously. Yeah.
See that sound? It's the sound of money.
It really is right now. I mean, it's like it's like you could want to buy a car right now, but it's just like buying a house. A lot of people want to buy a house, want to get a car, but it's not cheap.
Yeah.
It's not cheap. So,
and that's a good point. So one of these categories that we're seeing is it whether both used cars and shelter, those are so hugely determined by interest rates. And I'm thinking about this whole thing. You're talking about what does Powell want to do? I think that if he keeps it higher or if he raises it, that just gives him it's like makes him feel tough. And I think that's such a big thing. Yeah. But I also think it gives him a bigger tool to lower it down. And we haven't seen that. And I remember talking about this like 6 months ago, if these problems are caused by interest rates, all they got to do is dial it back down. I haven't been thinking about that too much.
Well, and we don't even know that the problems are even caused. It goes to show how strong the economy is, how strong the demand is for housing. That that is incredibly sensitive to interest rates, and rates can be risen to where they have been. I mean, mortgages are 7%, 8%, which I know go back to the late 70s, early 80s, and that was normal. Late 70s and 80s, that was the aberration. That was not a normal time in history. Yeah, that we're not necessarily going back to, but it's really expensive. It's all relative. Things are all relative. You can't say, well, because people say like actually rates are still low compared to when I remember when my parents bought their house and or when I bought my first house, and it's like, okay, that's your relevance.
Yes, the businesses are set up, the deals are set up for this environment, not for the 20 years ago environment.
Yeah, exactly. It's like, how far do we want to go back? Around the long-term average, if I'm remembering right, for like, general interest rates, like historically going back hundreds of years, if not 1,000 years, is like 5%.
Yeah.
So like we're not like too far off, from 5% right now. So like, rates aren't like abnormally high in that context. I would not call them low. I would call them higher than average over like the long historical context. Yeah. But very high relative to how the economy has adapted to a low rate environment over the last, decade.
And all this stuff, set up for, it's like more trusting or things that get, if interest rates are an expression of risk, and maybe back 100 years ago, things were maybe a little bit more risky.
Absolutely. Things were more, absolutely. Things were more risky.
I was getting a little out of my depth there, philosophically.
It's okay. Well, Matt, before we go on to talking about student loans, because this I think it's all in the same, topic what we're talking about. talking about housing demand, this is all how affecting multifamily, whether from the borrowing side to rental demand. But another thing that I think this is going to be resolved, but the potential the Teamsters strike for the UPS workers. I don't know if you've been following the story. So there's been huge trade negotiations between UPS, represented by the Teamsters. It's the union shop, and UPS. They're going for obviously pay raises. They're at a deadlock. I think the Teamsters and the employees basically walked away from the table after UPS made an offer. They're like, no, no thanks. They move around a lot of stuff.
Yeah.
Supply chains.
Yeah.
There's obviously other sources to get stuff moved around, but UPS moves around a lot of stuff. And again, I think it's short term. I don't think it's going to materially affect things. But when we're going by month, play by play, and every new data point moves things. Yeah. That could be something that would be like we didn't realize, weren't really keeping our eyes out open for, and all of a sudden we could have a slowdown in goods deliveries. That's not China related. It's just an internal, like a labor dispute.
I read somewhere that people get more amenable to the idea of unions when economic times are good, or at least like things are going well. It's fine. Union, that'll help me get a little bit more money.
When times are good?
When times are good.
Because they're saying that, like, hey, things are good, I should be getting more.
Kind of.
And like my employer, like you've got the money.
This is the logic that I thought was. And then but when times are bad, well, I got to get a job. I don't care about union. I just need a job.
Yeah.
There's a logic there. But I do think that was it the Biden administration got in the railroad strike? Things were that big, and they had to step in because they knew the implications of stopping moving things.
Yeah, and I think that's exactly what's going to happen in this case too. If it even gets close to that, I think the government's going to step in. Yeah, and do something and say, like, look, UPS, you need to. No, I don't think it's not the government's like job to do that, but that they see it as if it's an existential threat to inflation. And again, the federal government, they're paying. Think about the interest the federal government is paying right now.
I think it would hurt the economy more if the strike continues, rather than. I think that whatever concessions they give is not going to really bump up the shipping that much. If the real pain is things aren't getting moved around.
Yeah, no, I don't think it's the shipping price isn't going to get bumped up, but people stop moving things around. Just the last thing, and then talk about student loans. It can be adding another thing, but the whole war in Ukraine. It's very inflationary in general. We're spending a lot of money. There's a lot of arms manufacturing. It's been disruptive. Now a lot of that's priced in and sort of normalized. But if that stops, which who knows? I think that most interests in the United States want the war to keep going. Indefinitely. We no longer have wars in the Middle East we can keep pumping whatever into. So we got to have some conflict. To keep eyes peeled somewhere else, and Lockheed Martin.
Keep all the government manufacturers factory running for sure.
Got to keep making stuff. Got to make that artillery ammo. We got to make some more Abrams.
One for me.
What? Why not? Anyway. Yeah. It's being driven by profit at this point. Yeah. And so I don't think it's going to end anytime soon because of that. But if it does, that would also be a turning off the faucet of some inflationary pressures. Yeah, which was basically the reason why they said initially that inflation is no longer transitory, is because there we go. Is because this war in Ukraine. Yeah. Inflation. That's the problem. So that those are just those are the we're putting stuff on the board. Well, we don't know what's the weighting, but it's what's going on.
Does seem though general trend going down.